Now, as we all know, the tax in Canada is very, very high. And with high taxes, it comes a lot of incentive for people to look for ways to lower their tax either right now or in the future. However, because the Income Tax Act is so enormous and complicated, a lot of people, including myself when we first start, have a lot of misconception and misunderstanding on what is allowed when we're trying to lower our income and save taxes. And one of the most common tax mistakes people make in Canada is probably opening an account for your lower income spouse and investing via that person. Now, this may make sense on paper because if you open an account for that person and that person makes capital gain, interest, dividend, whatever, then it should be just taxed for that person, right? Well, according to the Income Tax Act, you are going to trigger something called income attribution. So today, let's talk about what income attribution is, when do we trigger this, how to properly lay down the groundwork so we can avoid such problem in the future. Now, before we start, I just want to try something new and do a quick survey with everyone that's watching this video. Do you think Bank of Canada is going to increase interest rate 0.5% the next time they meet? If you think they will, hit the like button for me. If you don't think they will, hit the dislike button for me. I want to use this to not only increase our interaction, but also as a survey to see what most people are thinking. So vote by hitting the like or the dislike button. Alright, with that said, without further ado, let's jump into today's video. Alright, so first let's talk about what is income splitting. This is actually a big deal in Canada if you want to plan your tax and have a lower tax overall in the future. Because in Canada, even though if you are married with your spouse, when you file tax, each person is actually filed their own income at their own tax bracket. So because of that, you could have one spouse at a very high income bracket like 40% plus, while having another spouse, let's say a stay-at-home mom or dad, having a very low tax bracket like 20% or lower. So this is why we want to split our income if possible, especially when it comes to investment. But like I said, this is where the problem of income attribution will come in. So basically what that means is when a lower income spouse earns interest, capital gain or dividend, but that gain needs to be pushed back to the higher income spouse because CRA sees the original capital to be from the higher income spouse, not the lower income one. So if that happens, then that kind of defeats the point because the higher income spouse will now have to report that income on their own income tax. Not only that, usually these kind of attribution may happen a couple years after. So CRA may come back and say, well, you misfiled originally. So not only you have to pay the higher tax, but the tax that you have been owing for these couple of years, we want to charge you interest on it. So it could end up more than what you would have paid if you just invested via the higher income spouse. And these kind of income attribution can trigger not only with your spouse, but also any family member that is deemed as non-arm's length. So for example, your kids, your brother and sister, etc. Now you may say that's easy to fix, then why don't I just gift the money first to my spouse or to my kids or whatever family member and then let them invest so now they can actually report those gains on their income tax, right? That's exactly where the misconception is. Sometimes simply gifting the money to someone else inside the family is not enough to avoid income attribution. In fact, that's exactly what will trigger income attribution. And this really depends on who you are gifting the money to. So on the screen here, I put a summarize on the different categories of family member that you can give money to and if it will get attributed back to you or not. Now, as we can see, if we give money to a spouse to invest in their name, any investment income gains or losses will be attributed back to you. This also applies to non-arm's length minors such as children, grandchildren, nephew, nieces, etc. However, if they're adult, then there will be no attribution. Another thing to keep in mind here is that we are just talking about investment income. If you were to gift this money to your spouse, but they take this money to start their own businesses, then those gains from the business will not be income attributed back to you. And also for investment income, keep in mind that it's only the original gains that will be attributed back to you if it were to happen. The gains on top of the gains through reinvestments will not be attributed further. So if your investment makes $1,000, the first $1,000 will get attributed back to you. But if your spouse take that $1,000, reinvest that into stocks and make another $100 on it, that $100 will not be attributed back to you. It will stay with that spouse. So it's just the first tier that will be attributed. Now, even though income attribution rules limits our ability to split our income, There are still ways that we can get around this, so today let's talk about them one by one. The first one will be to actually invest with your lower income spouse's own income. So if your spouse still works but just at a lower income, you can arrange your finance in a way where you as a higher income person pays for all the expenses inside the household while the lower income spouse invests their own money directly. That will work because the investment capital did not come from you, so there's no income attribution. Now, the second way is the income on income, which is what I talked about before. It's only the first tier that will be attributed back to you. Reinvestment will not. However, I would say in most cases it's not really useful because it's really the first gains that is triggering a lot of the taxes there. That's really what we want to avoid. But nevertheless, that's still a way that we can use to avoid some of the attribution. So then let's talk about the last way, and this is the one that I want to make sure we understand because it's likely the one that we will use most of the time, which is to have a prescribed rate loan between the spouses. So this one is very useful. Instead of gifting the money to our spouse, we are on paper loaning this amount to our spouse before we invest that money. Now later on, I'll break down to you why this would make sense tax-wise. You're still going to come out ahead versus just investing directly through the higher income person. But first, there are a couple of things we need to be aware of if we want to set this arrangement up. Number one is that the interest rate on the loan agreement needs to be at least CRA's prescribed rate. So every quarter, CRA will establish what is their minimum prescribed rate on their website. You can simply find it by Googling CRA prescribed rate. The first link is usually the right one. So for example, as we can see here, Q2 2022 prescribed rate has been posted, and we see that it's the low interest rate of 1%. So if you were to do this loan agreement right now inside Q2, you would have to charge your spouse at least 1%. You can charge anything higher than 1%, that's fine as well. But if you charge anything lower than the prescribed rate, then again, the income attribution will kick in. Now, number two is that you can loan as much money to your spouse as you want with no restrictions. Number three is that this needs to be a proper written loan agreement. So for this to be proper, there are several things you need to do. Number one is you need to be evidenced in writing by either a loan agreement or a promissory note. Number two, provide the names of the borrower and lender. 3, stipulate the amount loaned, so which is the principal. 4, stipulate the interest rate that is charged. 5, stipulate that interest for the year is due and payable on and before January 30th of the following years and be properly signed and dated. So all these needs to be on the loan agreement, and the thing that I wanted to emphasize on is, which is also the fourth point, is the payment date for the interest. All loan interest payments have to be made before next year's January 30th. So if you were to start a loan, let's say right now around April, you can accumulate the interest, but all the interest for this year from April today to the end of the year will all have to be cleared out and paid for by January 30th of next year. So make sure you pick something easy to remember, maybe like January 1st, and then set an alarm clock to remind you to clear out the interest payment on that date. Now, fifth point is not required, but it's recommended. You should have individual bank accounts to keep a clean track record of money payment and money flow. So for the best practice, the investment principal should sit in the lender's own bank account first, and then once the loan agreement is signed, you transfer this amount to your spouse's own bank account, and then it's invested through that account. So you have a clean record of money moving from one page to the other and then investing with that money. Similarly, with the interest payment, you should have the money sitting first in the spouse's own account. And on the payment date, you transfer the interest from your spouse to your own account. So you show a clear flow of interest payment as well. Now, number 6, which is also very important, is that this loan rate does not change until the loan is paid off, no matter what is happening to the interest rate. Whatever prescribed rate CRA posted for that quarter that you're using for your loan agreement, it gets locked in for life until this loan agreement is completed by paying back the investment principal back to the lender. Which is why right now is a perfect way to do this if you're thinking about it, because we're still at 1%, but with the interest rate increasing, very likely prescribed rate is probably going to be 2% or higher for Q3 or Q4 this year. Now, if you have done a prescribed rate loan already at a higher percentage from before, but you see it at 1% right now, and you want to have a new loan agreement or kind of reverse it so you lower the prescribed rate, you can also do that. But before you do it, I highly recommend you talk to a CPA, an accountant, to go through all the tax consequences first before you pull this trigger. because you probably have to sell all your investment, pay it back, and redo the loan again. And the cap gain you may trigger, depending on how much you have in there, may far outweigh the interest rate that you save for that 1 or 2%. So make sure you talk to your CRA before you do anything. Now, number 7 and the final point is any interest paid from your spouse to you for borrowing this money needs to be reported on your own tax filing because you're making interest income on paper, while your spouse have the ability to write that off on their side if they're using the money for investment that can generate income or has the potential to, which means anything basically stocks, mutual fund, ETF, dividend paying investments, rental property can all do so, except for things like land investment or pre-sale property. Those probably don't have an ability to generate incomes, so the write-off won't be allowed by CRA. So with that being said, then let's look at how much better off are we with a loan versus with no loans. So I've made a very simple example here. Let's say Peter has 100K from his side that they want to invest. Peter at a 40% tax bracket, Mary at a 25% tax bracket. Now let's say this 100K generated 5K of interest in the first year. If they were to directly invest through Mary's name, without the loan, like I said, they would have to be attributed back to Peter and he has to pay 40% tax on this. So they pay 2K in tax and they keep 3K out of the 5K gains at the end. However, let's say now they have the proper spousal loan and Peter has lent Mary this 100K first at 1% a year. Now, 3 things will happen. Number 1, Peter will make $1,000 of interest from Mary that he has to report, which will be 40% taxed, so he has to pay $400 tax on this. After tax income would be $600 for the interest that he made. Number 2, Mary has to report the 5K on her side as her income now. And number 3, Mary can write off this 1K interest cost because this is an investment that generated interest, which means Mary net taxable investment income is going to be 4K, taxed at her 25% bracket. She pays $1,000 in tax. Now, if we add everything together, their total after-tax income is $3,600, which is $600 more versus if all the gains were taxed under Peter's tax bracket. So, as you can see, this is why income splitting via a spousal loan agreement could make a lot of sense and save yourself a lot of tax in the future. Now, who should be using this and thinking about this? I would say, first of all, you should max your TFSA account for both spouses first, because if you haven't done so, doesn't matter where the money comes from, husband or wife, putting it in whoever's TFSA account will not have income attribution back to you. So you should do that first. Now, after that, if you have an income tax bracket a discrepancy, I would say more than 10%, that's when you would want to think about this loan agreement arrangement if you have a large lump sum coming from the higher income spouse that you want to invest with. So that's everything I want to share today on the loan agreement, income splitting, and also income attribution. I hope I have said something that can help you out to plan better in the future. If you have any questions or if you find them helpful or anything you want to share with me, let me know in the comment down below. And like I said already, do you think the Bank of Canada will increase interest rate at 0.5% in the upcoming meeting? If you think so, let me know and vote by hitting the like button. If you don't think so, then hit the dislike button. There's something new I want to try. I want to see how well it works in terms of interaction. And as always, if you like my videos, I do upload them 8:30 EST every Tuesday. So make sure you subscribe to my channel, click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!